I'm Renee, and I am a community development mortgage loan officer with Cadence Bank. And I just want to take a few minutes of your time just to share with you some of the products that Cadence have to offer that I think would be very beneficial to you and your clients. There's two particular products that I really want to focus on, and it's called our Right at Home Classic and then our Right at Home Emerging Communities. And at any time, please ask questions because I want you to really understand how these products work, because we have done, using our Right at Home, we have done over $1 billion in loans to our low to moderate income clients and our middle and upper income clients. So it's a very good product if you understand how it works and how it can benefit those particular communities that you serve. So first, I'm going to talk about the Right at Home Classic. And I'm just going to read a little bit. At Cadence Bank, our vision is to help people, companies, and communities prosper. To do that, we need to meet our borrowers where they are in their financial journey. Our Right at Home product is tailored to borrowers with properties located in low to moderate income areas or borrowers within qualifying income limits. We do provide on the Right at Home Classic up to 100% financing. 100% financing means no money down. It has a fixed rate. There's no mortgage insurance required. We have reduced fees, and it can be a purchase or refinance of a primary residence. The maximum loan amount is $500,000 with a 640 credit score, and you can go up to the conforming loan limits with a 680 credit score. Now, as far as the primary residence, you do not have to be a first-time home buyer, but you cannot own a home at the time of closing. So always keep that in mind. And then we have our Right at Home Emerging Communities. This is for borrowers with properties located in minority census tract. The program is best for borrowers on a path for economic growth, but do not have sufficient savings required to make a down payment. Again, it's 100% financing, meaning no money down. It has a fixed rate, no mortgage insurance, and the same maximum loan amount, $500,000 with a 640 credit score, conforming loan limits with a 680 credit score. The income limit is up to 200% of the MSA median family income. So the difference in the two, the Right at Home Classic and the Right at Home Emerging Communities, the Right at Home Classic is for LMI, low to moderate, no income limits. Long as the property is located in a low to moderate income tract, no income limit. If it's outside of a low to moderate income tract, they can go up to 80% of the estimated median family income and still qualify. If the property is located in a middle or upper income tract, it has to be 50.01% majority minority, and it has an income limit of up to 200% of the median family income. Those are the two different qualities on these two different products. They're similar, but different in little ways. So anybody have any questions on?
I do.
Okay.
How long do you have to be on your job to do any of it, I guess?
Mostly all products require a 2-year work history. 2 years consecutive work history. If you don't have a 2-year consecutive work history, as long as it's in the same field or you left the previous job to make more money, you can still qualify.
For instance, I know someone at your job for maybe a couple of months. Like that is that they got another job, but it's still the same field.
Okay, and then as long as you have a reasonable explanation as to why you change jobs, or if there's a employment gap, if it's a reasonable explanation, we still will accept that. It can't, it can't be just because you just decided you wanted to quit working and want to go play around and then come back and work. It has to be a legitimate reason why you have that employment gap. Mm-hmm. So on the right at home, this shows the credit score, the debt to income ratios, and the loan to value. The property on a primary residence, which would be a 1 unit, the credit score, as you can see, these two, 640, 640, 40% DTI, 100% maximum loan value. 640 with a 45%, 95%, and then a 680, you can go up to a 45, 100% financing. Primary residence, 2 units, 640 and 680. The DTI is the same, 45%, and it's 90%. So you would have to put 10% down if you're doing a 2-unit property, but you still get the waive on the PMI. And the rental income on the 2-unit cannot be used to qualify. So the client would have to qualify for a 2-unit property without using the rental income. They would have to put 10% down, and there's no PMI. Any questions on that? And then this chart here shows the program income limit comparison. On the right at home, again, like I stated, low or moderate income census tract, the income limits is none. Your client can make $1 million. If the property is located in the low to moderate income census tract, they qualify for 100% financing, no PMI. If it's in a middle or upper income tract, the income limits is 80% of the estimated median family income. If it's in a middle or upper income census tract, they can still qualify for the right at home, 100% financing, no PMI. For the right at home emerging communities, again, it has to be majority minority census tract, which meaning 50.01 majority minority, middle or upper income census tract, and anywhere from 80.01 to 200% of the estimated median family income is the cap.
Renee,
Mm-hmm.
this is Sandy. So I get this question all the time, but the area and median income, is there a chart with Cadence similar to the city of Houston?
It is. We use FFIEC geocode. Let me see if I can without messing up. Let's see. Can y'all still see my screen? Okay. Give me an address. Somebody give me an address.
416 FENN.
We're seeing this one.
Oh, shoot. Let me see. So I need to stop sharing that one. Okay. And then
Reshare.
and I'll see that button on here. Hold on. Share. Okay. Is it still sharing the same one?
It's still so yeah,
It's okay. Okay, so how do I don't want to get out of here. Just the screen I want to share right here.
Okay. Do so we can see the
That's what I want to share. That's what it is.
This one,
Mhm.
I'm looking for your Zoom. There it is.
The one where it gives her the options of which screen she wants to share.
So maybe click the entire screen. Will it? That, yeah. Mhm. Sorry about that, guys. Now, what's the address, Laverne?
For this. FENN.
Is that Houston?
The system tax is 77. They throw it through that.
So if you go to the FFIEC geo code, this screen will pop up. You will put in the address of the property and you click on it. And you see how it brought up this information over here on the side, and then it has this census demographic data. If you click on that, then you look right here, it shows you track income level, moderate. So that way you would know automatically this property will qualify for low to moderate income track, meaning there's no income limit on it. So that's what you would look for. You would look for in this top section, if it's a low or moderate, that means 100% financing, no PMI, no income limits. 640 is the minimum credit score.
No PM. No.
Money down. Mhm.
But you need 640 credit score.
Right. 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 Mhm.
So if you want to put an address in and nothing popped up, does that mean it's not on that?
More than likely it's gonna, if it doesn't pop up, we have to do a little bit more research to find the address. We do have another system that we use to locate addresses as well. 100% financing. They would just need their closing costs. So most of the time, if the realtor can negotiate closing costs, the client can possibly come to closing with little to no money. They do have to put at least $500 of their own money into the deal. So usually if they pay for their appraisal using their checking account, that will satisfy that 500 minimum required from the client. And they can get up to 6% seller concessions on this particular product. And that's all on these flyers that I have. FFIEC. FFIEC geocoding. You can. And if anybody want to do like a one-on-one practice with me to kind of practice how to pull up addresses, I can, make time to do that. Or if you just want to send me the address, I'll look it up for you. That's no problem. Yeah. Yeah. Okay. Okay. You're welcome. And then also when you look here, if it pops up middle or upper in the track income level, then you want to go down here where it says track minority percentage. You want to make sure that number is at least 50.01. And then that will let you know that it qualifies for the right at home emerging communities that require the property to be located in a middle or upper income track. Has to be 50.01 majority minority, and they can't make more than 200% of the estimated median income. And I know someone had asked about how do we determine that. If you look right here where it says 2025 FFIC estimated MSA, median family income 102, we do that times 2. So that means they can't make more than $204,000 for the emerging communities.
So then for the most part, they still do need to talk to you first because they need to know that they qualify I mean, because we really won't know all that unless they talk to them anyway.
Right, they would do the pre-qualification with me first, which if they know the property that they're looking for, I can always look it up in advance and tell them if it qualify for the program. So yeah, that's how that would work. But this is the system that we use for that particular to try to determine that. We also have another system that we use. It's called Terra Value, and it pretty much does similar capabilities. Give me another address.
BEL.
BELA, Bell Arbor Street. Okay. Okay, so you see how this popped up here? If I click here, and I can give you guys these maps. This is our LMI map. Any of the what happened? My screen stopped sharing. Okay. Any of the dark green shaded areas are all the areas that qualify for the low to moderate income tract. If you see where the address is right in here, it tells you the county, the census tract, the income level is low, the median income, the minority percentage, the Hispanic and Black. So any of these dark green shade areas, and I can also like focus on a particular area if you want me to. I can, make it bigger and focus on a particular area. So there's all different ways I can help you guys as realtors know what properties qualify for LMI and what properties qualify for the emerging communities. And I can also send you a copy of the map. That property, because it's in a low. Anything in the low to moderate, so low to moderate LMI in low to moderate income tract. This dark gray shaded map, these are all the properties that qualify for the right at home emerging communities. That's the one with the middle upper, 50.01% majority minority, and it has the 200% income cap. So those are the difference. And that I can provide the map for you as well on that. But as you can see, there's a lot of areas that qualify for these two programs for your clients that can get up to 100% financing, no PMI. So these are very good programs, and I really want you guys to get to know these products and understand them so you can refer them to your clients, okay? Mm-hmm.
Get up to 100% financing.
No, up to 100% financing. The income limit on the emerging communities is 200%.
So
Yeah.
in the community, the low income for sure.
Mm-hmm.
They can get up to 100%.
They can get 100% financing. It's not up to. No, they get 100% financing too. The down payment side and the income side is two different numbers. So the down payment is no down payment on these two products. That has no bearing on it. No down payment, 100% financing, no PMI, meaning you only need your closing costs. Yeah. And then the income limit on the emerging communities, 80.01 to 200% of the median income. And that is on the flyers that I have for you guys that I'm leaving with you. And so I'm going to stop sharing this screen and go back to the other screen. Do anybody have any questions on these two products, how to tell the difference, what to look for? Income limits, any questions?
I think sometimes at 100%, it's like really 100%.
Right. So that's why, because a lot of times when I say 100%, sometimes people think they don't have to bring any money to closing. The 100% financing means no money down. You still have to have closing costs. And again, on both of these products, the seller concessions can be up to 6%. So again, they can basically probably get into these properties with little to no money down for closing, you know.
And actually, I think because that was the program that we used when we used with
Tonya.
Tony, right?
Uh-huh.
And that was one of the programs. So
Right. And sometimes you can get money back. So on these products, the most money you can get back would be your earnest money. So if you're getting the max on seller concessions, sometimes that'll allow for a client to get money back, or they can use that money to buy the rate down as well. On these two products that we have, we are giving a 1% discount off the rate at no cost to the client. So the base rate today, I think it was at 7.25. With the 1%, they can get a base rate of 6.25. So it's a very good product that Cadence have, that they have came up with to be able to help low to moderate income individuals be able to become homeowners. And like I said, we reached our $1 billion mark last year, and we're very proud of that because of all the families that we have helped get into homes that didn't think that they could afford to get in a home. And that is such a joy in my heart when I'm able to help a client become a homeowner who never thought that they were going to be able to become a homeowner, because they're thinking, you got to have the 20% to put down. That's a myth. You don't need 20% to be able to afford a home. So those are some of the things that I can help clients with as far as becoming homeowners. These are the two products that I really, really wanted to focus on. But Cadence offer a lot of other products. We have our construction to perm and renovation to perm loans. If anybody is ever interested in those, I can refer you to one of our lenders that does those type of loans. Our professional, premier professionals, those are for our clients that make over $300,000 a year. They can get 100% financing, no money down, no PMI, fixed or ARM rates. And they have to have investable liquidity to qualify. So these would be more like, your doctors, your lawyers, your attorneys, your engineers, your oil and gas, people who make the 300,000 or more. They're still able to qualify to get no money down, no PMI, and the property on these for the professional and premier does not have to be in a specific income track. Okay.
And I have a question. So for those people that have student loans, they really just need to come talk to me first to see where they fall and what they really, because I know with the credit part that she was talking about, they just need to get started on the process to see what they need to do.
Right. I recommend all clients to do an application. Let's run your credit, look at your profile, see what your debt, and then we can figure out what next steps we need to go through. Student loans on the right at home, if your student loans are deferred for 12 months or longer from the date of your closing, we do not have to include them in your DTI. If they're not deferred for 12 months, you either need to be on an income-driven repayment plan, or we would have to include 0.5% of the total amount of your student loans and add that to your debt to income. And sometimes that can kind of, push you over. So if you can get them deferred, if you're looking to purchase, try to get them deferred for 12 months or longer. And then on our medical professional loans, these are for our medical doctors. They can get up to 100% financing, no PMI, no money down, no PMI, fixed rate, ARM rates. This can be primary or secondary home. Medical professionals include new or established physicians, medical residents, fellows, and it shows you the different types of doctor degrees that would qualify for this program. So this is another great program that Cadence offered to our medical professionals. So if you have any clients that are medical professionals, they can get into a loan, basically coming to closing with no money, so And that's up to the conforming loan limit. If they start going into like the $1 million, $1.5 million property, they may have to put 10 or 15% down, but they can still waive the PMI. We still waive the PMI on those particular, and they can be in their residency or doing a fellow. So, and then with them, again, if they are going to be in their residency or fellow for more than 12 months, we don't have to count those student loans as well. So there's some products that we can kind of get around the student loans. So, and then we do regular conventional loans, regular FHA, VA, USDA. We offer all of those. We also offer programs for our heroes, those of our teachers, firefighters, policemen, et cetera, et cetera. They can get 5% savings at closing. And if they purchase in the LMI area, that's $1,000 savings, no money down, no PMI.
The teachers, do they have to be a teacher, or do they have to like work for the school district? Like have like a Dutch driver. Will they qualify for the teacher?
They're not a hero. No, teachers are, yeah, it has to be a teacher. They wouldn't qualify for the Heroes program, but if their purchases in one of the qualified areas, they can still get the 100% financing, no PMI. But another one might, right. And that's why I say it's always best. I recommend them to do the application. Let me run the credit, look at the profile, and then we can determine which product best suits that particular client's need. Because every client is going to be different. Every situation is going to be different. And then again, our preferred rate program on our portfolio products, if they open up a Cadence checking account and have their payment automatically drafted, we do offer them an additional eighth off the base rate. So they can get additional discount on the rate at no cost if they open a Cadence checking account and have their checking payment automatically drafted. Okay. And that kind of concludes my presentation. My information is up on the screen. Is it showing? Why is it not showing? It must have went off. Is it not? I don't know why it keeps going off.
This is what you wanted to share?
Yes.
This part?
Mm-hmm.
The name of it? Is this?
It's on the power. Yeah, there it is. Okay, so this is my information. If anybody want to do a one-on-one, we can set up a meeting to go a little bit deeper into these products. But I just wanted to give you an idea of who Cadence is and what we're all about and how we help. We do partner with a lot of down payment assistance programs. So if your client needs down payment assistance, once we get that application and we see what they qualify for, we can try to partner them with different down payment assistance programs. And the thing that I do really want you to understand with down payment assistance, just because a client is a first-time home buyer doesn't automatically qualify them for down payment assistance. To qualify for down payment assistance, some of the down payment assistance programs also have credit scores that you have to have. They also have debt to income ratios that you have to meet, and some of them have income limits. So not only do the client have to qualify on the lender side for the loan, they have to meet the guidelines of the down payment assistance program. So a lot of times I have clients say, oh, they told me if I just take this class and get this certificate, I'm a first-time home buyer, I can get down payment assistance. It's not that easy. They have to qualify on the down payment assistance side, and they have to qualify on the lender side. And sometimes the qualifications and guidelines can be a little different. So that's what we're here to help clients figure out how they can get that assistance. So we have a very good down payment assistance team that helps us out to figure out the different programs that are offered out there, but we do partner with a lot of down payment assistance programs. But again, just state to that client, they have to qualify. So most of them 640 credit score, 40% DTI. Some of them let you go up to a 43. Some of them let you go up to a 45. So there's different guidelines that we have to follow for that. But that's what we're here to help. Do tell your clients, because I get a lot of clients that say their realtors do not tell them about upfront costs. Down payment assistance cannot pay for a client's upfront costs. And when I'm saying upfront costs, that is your earnest money, option fee, appraisal, survey, and your third-party inspection. So make sure you're letting clients know that this money that they're going to have to come up with out of their pocket. Keep in mind, for closing costs, you can get a gift. That's an option. If they don't have the funds, they can get a gift from somebody to help with closing costs. So it's just different ways that we can help clients get into homes. And I always try to encourage clients, if you're not ready now, don't get discouraged. Let's come up with a plan, make the sacrifices, do the work, and we can get you ready. You know, it might be 6 months, might be a year, might be 2 years. And I want to tell a little success story that I started with a client. We closed this year, but I started with her 2 years ago, and she had like a 400-something credit score. And we came up with a plan. She worked the plan. She did exactly what we asked her to do. She got her credit score up, and she was able to close on her home. And I was so happy for her. But, you know, it's up to the individual client. What is important to you? Are you willing to make those sacrifices to get into a home? You know, so those are the things you have to ask your client, because it can be done. It can be done. You just have to, what is your priority? You know, do you want Amazon packages coming every week? You know, do you want to go out and eat and party every weekend? Or do you want to, you know, get into a home, start saving your money, start paying down debt? So, you know, I do try to encourage my clients, as long as you're willing to do the work, I'm willing to do the work with you, hold your hand, walk you through it, and let's get you into a home. So I appreciate you guys for taking time out to let me present to you. And again, I'm available to anybody to do a one-on-one, and let's get some loans closed before this year is out. Any other questions?
Motivated. And I even think about the buyer side on that, so I can let it go online, go on social media and spotlight the product.
Okay, and so I want to go over one other little product that Cadence offer, and this is for your clients who need to build their credit or get their credit score increase. It's called Cadence Bank Credit Builder Loan. And how it works is Cadence Bank will give you a loan for $1,000. We put it into a CD. You make 24 monthly payments. I think they're around like $43 a month. And at the end of that 24-month period, the $1,000 and the interest is the clients, and they report those payments to the credit bureau. So it helps you build your credit and your credit score. And the thing with that, the clients just have to make sure that they make their payments on time. That is key with any type of debt that clients have. You have to make your payments on time. I see sometimes on credit reports, clients will let $100 go on their credit report. They'll say, well, that wasn't mine, and it shouldn't have been on there. If it's something so small, pay that, fight it later. Do not let little things like that hit your credit that will stay on there for 7 years that could possibly keep you from getting a home. So just pay that little stuff off, fight it later, and keep your credit clean. That's my advice.
I like that. Pay it and fight it.
Yeah, right. Yeah. Don't let that little stuff get on your credit and take a hit, because something like a collection or a charge off, that can hit your credit 80 to 100 points. You know, so just be mindful when you're talking with your clients about things like that. But we're here to help. Thank you again. And I look forward to doing business with you.
Thank you.
One more thing, Renee, that I'm seeing a rash of is people are going out and using a firm or what's the other one?
Klarna,
Klarna,
Afterpay.
Afterpay, and those are reporting on the credit bureaus. So
Yes.
watch those.
And we do look at that when we're looking at your debt to income ratios. If you have those type of items out there, they look at the bank statement. That's one reason we get a bank statement. We getting those bank statements for a reason. We are combing through those bank statements to see what kind of revolving debt you have on there that did not come up on your credit report. That's the same thing for if you're paying child support or alimony or back taxes. Sometimes that stuff does not come up on the credit report. So again, advise your clients that whenever they're doing a loan, be honest and upfront with the lender about everything that they have going on financially, because we're going to find it out. And it's best for us to know it upfront so we can come up with a plan and not find out once the file has hit underwriting and then the file blows up. So honesty is key, because we can always work things through when we know about them. Thanks, Sandy.
Glad she said that, 'cause I have-
Uh-oh. Awesome job, Renee. Awesome job. Awesome
Yeah.
job.
Awesome
Thank
to you
you.
both, ladies. Thank you so much for coming out and speaking to us. We really appreciate it. Thank you, Renee, for lunch. Does anyone have any questions before we go? All right. All right. Well, again, thank you, ladies. I hope you have a great, safe rest of your day.
Thanks.
Yes.
Bye.
Thank you. Bye-bye.